classifieds. Because there we have a big potential in terms of property, electronics and everything which is there. This is on the non-auto side. So how should we look at it? Should it be a similar consumer business kind of a growth of 20%, or should we look at it like a 30-40% kind of a number going ahead in next couple of quarters?
So first, the consumer group this year at least has to grow higher than the car industry does, because the car industry is supposed to be at 0 to 5. So we're hoping that the consumer group growth is much, much stronger than double the new car industry growth for sure. That's one. But it is a factor of growth in the car industry, factor of growth on digital advertising, factor of growth of digitalization at dealerships and manufacturers and all of that. But we feel pretty optimistic about the position of the car industry or the new vehicle industry. Shriram Automall, you're right. I think the two things, one is to keep growing the retail business, and the fall in repossession is probably, we're hoping, bottomed out. But yeah, it is to keep growing the retail business, and repossessions during the year will probably, come back and volumes will increase there. That will give us the growth impetus we need there. On OLX, actually, we are very bullish on growth, and I don't want to put a percentage to it, but OLX is not governed by car manufacturers or car dealers or new car sales. It's governed by a very fragmented used car market. 45-50% of the revenue comes from the used car industry, and the used car industry sells 5 to 6 million cars a year. It's been robust and buoyant for the last 3-4 years. There are thousands and thousands of dealers who use OLX for selling these cars. OLX has reasonable relevance to these dealers. A large percentage of the dealer sales comes from OLX. It is the number one used classified platform in the country. And we believe that OLX has a tremendous opportunity to grow this business. And this growth, is something we are extremely optimistic about. And one of the reasons we acquired OLX is for this growth. The second area of jobs, homes, especially, OLX is the second two categories in OLX, biggest categories in terms of revenue. Both these categories, OLX is reasonably strong in B and C towns in India for both jobs and homes. And especially in homes, it's mostly for low ticket size homes. So it got its own segment there. And as I said, not in the immediate term, but probably in the short term, which is 6 months, it will take us 6 months to put teams behind this. We see tremendous growth opportunities in both jobs and homes as well. There are two other categories, which is bikes and electronics, which is OLX extreme. In fact, today, if any one of us want to sell a two-wheeler or a mobile phone, OLX is probably the platform we would use. And they're again very, very strong at that. It is a category we believe also we can monitor extremely well in the next 2 to 3 to 4 to 5 years. So we have lots of plans around all these categories. And therefore, we feel, as I said, I don't want to put a percentage of growth, but we feel very optimistic about the growth at OLX.
Got it. I just wanted to understand, now we have complete dominance on the used cars market. From the Cartrade acquisition 2016, the way we started 2012, started Cartrade, and now we have OLX Auto also. So how should we look at the J curve in terms of profitability? Because by today, if I see a profitability, we are probably on a run rate of 100 crore PAT maybe in FY25. How should we look at that J curve? Because we have worked really hard for the last 6-9 years to make this kind of a dominance. So when should we expect to see a very big jump in profitability for a company? Because now we're a very really dominant player in the field that we're operating. How should we look at that?
Yeah. So first, we have good relevance with, especially in used cars, we have strong relevance with used car dealers and used car consumers. I agree with you. I mean, with this 24-25 crore PAT, that's probably the current run rate of profitability. We do believe that with growth of revenues, the profitability should rise and margins should rise. That's the nature of the business. The cost don't go in relation to revenues. So we feel very optimistic about profitability for the next 1, 2, 3, 4 years, clearly. And we also believe that one of the biggest opportunities within the company are used car classifieds. We do believe that. With the acquisition of OLX, our ability to focus on used car classifieds with consumers and dealers becomes even stronger, OLX being the largest player at this. So clearly, used car classifieds is important. Clearly, it will help drive revenue growth and profitability growth for the group. Used car classifieds, the business is already profitable for us. In fact, all our business are individually profitable. So we feel, quite optimistic about profitability growth as well as revenue growth.
Got it. Thank you so much.
Thank you so much. Thank you.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Mr. Sahil Doshi from Thinkwise. Please go ahead.
Hi, sir. Good afternoon. My question relates.
Sorry to interrupt, Mr. Sahil. Can you please use the handset?
Yeah. Am I audible now?
Yes.
Yes. So the question relates to OLX. In terms of, could you just help us understand, what is the kind of paid listings we have, and what is the growth which we are seeing there organically, and how much of it is driven by ARPU possibly? I understand it's a little too early, but if you can just help us get a direction of that, that will really help us understand the size of opportunity.
Sorry, can you just, the ARPU of, sorry, I didn't get the last part. So one is the ARPU of?
If you could possibly bifurcate how much of it you are expecting from the ARPU.
ARPU growth and...
Yes.
It's hard to give percentage, but we expect a growth in number of dealers, the number of people paying, as well as ARPUs both.
Okay. So could you possibly quantify the number of paid listings we would have today in OLX?
As of now, we are not, we are not sharing that. We're just in future we will try and share some of the metrics, but it is probably the largest marketplace in India with consumer paid listings. We have two sets of paid listings. One is consumer listing for paid and dealer listing for paid. We are still not sharing the total number of paid versus total number of listings. Going forward, we'll try and share some of this data. But the objective is to grow all paid listers, and the objective is also to grow ARPUs per paid lister, both.
Understood. Appreciate that. So, is there any sense on the average ARPU? Meaning, what will be an average ARPU for a paid listing?
It's hard to say. We'll have to give it distinctly because it's by segment, right? So it could be a consumer listing a phone or a consumer listing a car. It is different, and that's live on the website actually, the cost for it. Or it could be a dealer again listing a car or a two-wheeler or a home so it's hard to put an ARPU to this. There's just different rates for different listers.
Okay, understood. Appreciate that. And the second question is on the standalone business, where we've seen a little bit of a dip compared to our past run rate of growth, at around 15% YOY this quarter. Any reason why this is happening? Is it because this is contrary to the fact that the number of users and the conversion, the organic traffic has actually gone up? So
that is correct. The organic traffic has gone up. It's higher. The standalone business probably had the best operating revenue growth, the best revenue, operating revenue ever in its history. So it is on a high last year base as well. The last year, as I said, grew again at a very high pace, and this has grown 20% Y on Y over and above that base. But also you got to remember that the growth in the car industry, from more than double digit growth the previous year has come down to 8% this in FY24 and only 2% in April, right? So there is also a bit of car industry growth factor here. But as I said, we feel pretty good about the industry state and the consumer group state, and I think these are now normal growth rates about what we're showing in the track record we had in the last 2-3 years.
Understood. Final question from my end is, sir, when do we see the initiative which we are working on, the one click and a lot of other initiatives around financing or the Cartrade or basically the website which you try? When do you see that actually becoming meaningful in terms of monetization for the platform?
So the one-click journey of giving an ability to someone to buy a loan or a vehicle is going on. There are already some elements of that live. For example, on financing, it's definitely live on Carwale, Bikewale, and multiple other platforms where you can get a loan immediately approved. We also work with various car manufacturers with their dealerships and their website to allow these finance products to work. And that's a continuous exercise for us. It's already become significant in terms of customer experience. I mean, tens of thousands of people get approvals every month on this technology of a financing or a fintech product. And the fintech product or the buy one click, we've got two parts of it. I think the first part we've always said is about customer experience, allowing consumers to have a superior financing or buying experience, which is what we primarily work on. The second part of it is, can we monetize it better? And when the monetization becomes significant. I think the monetization is something which is secondary to us right now around it. We've always said that this whole financing or buy one click is about customer experience and giving the ability for a consumer to have a quick, convenient experience to do something on Carwale, Bikewale, and even OLX in the next few quarters. The financing product will get launched there as well. So the intent is, of course, to take this buy one click journey across all our platforms, including OLX. And the intent is also to get better customer experience. Monetization, this customer is already monetized by way of charging dealers and et cetera, et cetera. We're not so worried about it. Our margins are also improving as we increase revenue. So we're not worried about that. I think the biggest thing for us is how do we enhance the use of this product, and then how do we make the experience of the journey of buying a vehicle or a used car or a two-wheeler more easy by this one-click financing or one-click buying approach.
Sure, sir. That is very helpful. Thank you, sir.
Yeah. Thank you. Thank you.
Thank you, sir. We have our next question from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. So you have given your presentation that you are close to 750 crores in cash balance in there. So how do you plan to utilize this cash, and if you can give any outlay for the same for the current year or the next year?
Yeah, the cash which is there, obviously the intent is to look at future growth in the business. OLX is a very game-changing acquisition for the group, and obviously over the next 2 to 3 years, as and when we find another opportunity, we will look at it. And if we don't, we won't. And obviously our intent will be over a period of time to distribute it back to shareholders and stakeholders as we go on. So there could be two uses, as I said. One is probably in the near term or medium term, if we do find another M&A opportunity. As you know, it takes a long time for us to find something. After Shriram Automall in 2018, OLX was in 2023, so it was 5 years later. So until we find something and we feel really good that we can turn it around and exploit all the synergies, obviously we won't make an acquisition. And if we do not, as you know, we are profitable, generating cash, and the 750 crores will keep growing, and we will obviously look at returning it when it's possible to do to shareholders and stakeholders, obviously.
Oh, that was. Thank you, sir.
Thank you.
Thank you, sir. We have our next question from the line of Rahul Rahane from Goldman Sachs. Please go ahead.
Hello.
Hello. Hi, Rahul.
Hey, Vinay. Hi. Just wanted to get an update in terms of, the AppSure foray that we had in terms of certified vehicles, how is that going? Because I think couple of quarters we've kind of not mentioned the number of outlets, etc. So just wanted to understand how that's going. What's the throughput over there? Just some.
Actually, it's a good question. The OLX acquisition actually changed this a little bit, where OLX also had an equal number of or similar number of certified stores, OLX stores. So by force, obviously number of stores we have doubled, which I think is close to 220 or 230 today, automatically. We are working on a very deep strategy on how to look at these stores in relation to where we want to grow it, number one, of course, but also do we want to combine the OLX Carvale store or not, or at least not that we're not combine the stores, at least provide similar technology and features and products to both stores, right? So that's a big game-changing thing. But independently, the Carvale, AppSure, and Signature stores have grown, and independently we have acquired OLX. So it's actually doubled our coverage automatically, and it's a very big focus area for the next 12 months to first come out of the product, which is uniform for both OLX and Carvale stores, and the second is to, of course, then keep growing these stores, both of these.
Got it. So currently they are running independently, but you would look to, let's say there is someone who sold his vehicle on an OLX, the same car probably sometime down the line will also be available to sell on Carvale AppSure.
We're still working through the modalities of how do the franchise store of OLX and Carvale get the same, products and services. So it'll take us some business where the synergies, come in, and it'll take us some time. But the fact that there are 220 coverage points makes us very excited about this area. It's actually doubled our coverage automatically, actually.
Understood. And on a standalone basis, in terms of AppSure, would they have kind of stabilized now in terms of, profitability on a per store basis? What's the throughput, number of cars required per month? Any kind of.
Yeah, it is stable. It is quite stable, but it's also always, because it's an asset-light business for us. So again, it's a reasonably high margin business. It doesn't, there's very little cost against it except variable manpower. There's, as I said, no marketing cost against it or no capex against it. So it's just variable manpower which work on the process and systems of the store. So we feel it's a very attractive business for us. And that's why we feel excited about the OLX acquisition. Not only has the used classified business, but definitely has the signature/AppShop business as well.
Got it. And just on the consumer piece, if you could, kind of say for the full year FY24 versus 23, a broad split between, our revenues, how much would have come from auto manufacturers versus
Yeah, it's pretty
dealers?
stable. Actually, we didn't, this is my mistake, that we didn't do this on the original presentation, but it's pretty similar. 85-15 is new and used, OEM dealers about, 65-35 in Q4. This is quite stable. In fact, some of the other metrics were, repos for the year is about 49%, which is, down, which is 49%, slightly lower. So I think the percentages are quite stable to what they were the previous quarters, so we have not given it out. But yeah, your question was on OEM versus dealer, 65-35.
65-35. And this number, let's say, going forward, in a scenario where now there is no, kind of pent-up demand on the customer side, one would assume that OEMs will need to spend more in terms of advertising, right? To kind of attract demand. So this proportion would ideally move in favor of OEMs. That would be the right way to think about it?
No, we think the other way around. Logically, should move in side of dealers, but it's been quite stable over the last 4-5 quarters. So it's hard to say, but we actually believe that, it should be quite favoring dealers as dealers advertise more. It is more from that angle. But as of now, it's been quite stable, actually, to be honest.
Okay.
Yeah.
Sure. Thank you.
Thank you.
Thank you, sir. We have our next question from the line of Nitin Shakdher from Green Capital Single Family Office. Please go ahead.
Hi, good afternoon, Vinay. Good afternoon,
Hi,
Anisha. First of all, congratulations on the steady bounce back and the promise that there will be no further write-offs on the business. So can we take that as gospel that there shouldn't be any further one-off write-offs because that spoils the annual trend?
Actually, the only write-off we had was on discontinuing a business which we had said we had discontinued. Otherwise, we've not had one anyway. So, I don't want to talk about the future, but clearly in the last couple of years, the only thing has really been the one discontinuing business, which is a company which we acquired and kept it classified as because of C2B. But there's no anticipated write-off, if that is the question.
Okay, great. And my second thing is you spoke about briefly, but I just want to get a bit specific. Like, obviously, the cash and bank balance is far healthier right now to what it was last year, and the closing position seems fairly good. Now, while you're doing acquiring and M&A and strategies which take time and synergies built up over time, I just want you to consider specifically a solution for existing institutional as well as shareholders in terms of can you evaluate a buyback? If that's accretive towards your ratios and things like that, or a dividend strategy, because, it has to be something given to shareholders as well, considering you came in at 1,500 on an IPO and it's, already 2.5, 3 years. There has to be something. You're constantly expanding the ESOP pool, but I don't see you returning a lot more back to the shareholders at a significant push there. Any thoughts on that?
Sure. I think two things. One is that in the IPO, we did only secondary, no primary raise into the company, number one. The second part is actually if you look at the ESOP cost for the last 3 years, it continuously come down. So that is the second part, from 27 crores down to 22 crores this year. The second part is that. The third was we would absolutely look at, buybacks and dividends as and when, we think that the money can be distributed back. There is regulation today dictating what quantum of buybacks and dividend distribution we can do. So we obviously have to work within the guidelines of the regulation and we're restricted from doing certain things by regulation itself. And, as and when the regulation allows us to distribute in terms of buyback or dividend, we'll absolutely would like to do so.
Yeah, I mean, it's just a request. At the end of the day, the company knows better in terms of financial management and engineering. But I think you should consider that also significantly for this year, considering at the start of the year, and put that as how you could sort of work on that. That's just a request.
We will, but we can only do in the constraints of the regulation. That's all I'm saying. So, and the Companies Act, right?
Okay, thanks a lot.
Thank you.
Yeah.
Thank you, sir. We have our next question from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, for FY24, our net revenues have grown by 32%, while our adjusted EBITDA has grown 63%. So can you indicate, like, how are we looking our revenue growth at for, let's say, for next 2 to 3 years? And will it be fair to say that our EBITDA growth would be 2x of revenue growth going ahead also?
Yeah, we see a strong position in terms of revenue growth, et cetera. And we also indicated earlier that, you know, our profitability tends to grow at a much sharper pace than our revenue growth. It tends to be 1.5 to 2 times, you know, more, I would say more 1.5. If revenue goes 100 rupees, then profitability tends to go by, you know, 150. I think that is by if 100%, then 150%. So, or 1% and 1.5%. I think I would take that ratio. That's what tends to be. Sometimes it's better than that. Just now it is currently better than that. But it tends to be that's the way it grows. Because our costs which go up along with our revenue growth are only our people costs.
Okay. Thank you.
Thank you.
Thank you, sir. We have our next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you, and congratulations for a good set of numbers.
Thank you, Tushar.
Yeah, I wanted to ask on this Carwale, your revenue has grown, but your expenses have grown higher. And this is a fairly mature business. So, you know, how does the operating leverage play out in this business?
So if you see, the revenue growth is for the year is about 20% from operations, standalone, which is our consumer group. And our expenses have grown by, I think, 16%. Anisha, is that correct? 16%. So the actual expenses have not grown the same rate as revenue. That's why we have 41% growth in adjusted EBITDA.
Okay.
So actually the way to look at it is revenue growth is 20%, adjusted EBITDA growth is 41%. So,
not the quarterly numbers.
Yeah, I'm looking at the annual numbers. You look at the standard
accounts. Revenue has grown 19% and even employee cost has grown 19%. So, you know.
Employee cost has, but as I said, the marketing cost only up 7%. Other expenses are 15%. So aggregate.
But this is a business based on internet advertising, right? So why would employee cost go up?
It is not necessarily. It's a mix of course, internet advertising from manufacturers and dealers, but it's also about adding more. All our technology development in the future goes to revenue expense. So if we develop future technologies in a tech product team, any expansion goes to employee cost. Any expansion of field force or call centers goes also to employee cost. And that's the number one cost which, you know, tends to go up. As I said, in a lot of companies, employee costs, marketing costs, operating costs all go up. In our case, variable manpower is what goes up, and we, you know, as the company keeps growing. And therefore, you see even then a 20% revenue from operation growth has got a 41% growth in adjusted EBITDA.
Okay. And on the OLX acquisition, what is going to be your policy to write off the cost of acquisition? Are you going to expenses to P&L or will it carry on in the balance sheet?
The OLX acquisition is being captured as in our goodwill. The acquisition value itself is captured in our goodwill, which is reflecting on our balance sheet. And actually, the objective is to give a return on that capital employed and not write it off, because we obviously believe that the acquisition itself is value creating. So.
Okay, so no plans to amortize it?
No, there's no amortization of goodwill, no.
Okay, thank you.
Thank you.
Thank you, sir. We have our next question from the line of Vijay Jain from Citi. Please go ahead.
Yeah, hi. Thank you for the opportunity again. Two follow-up questions. One, you know, Vinay, in general, for the standalone business, for the industry overall, you know, just your comments on, do you see dealers being subdued generally in F24 relative to other segments of the business across new and used businesses? In general, whatever you can talk about, what you see on the dealer side for the industry. That's my first question.
Do you see dealers mean in terms of supply, or do you see them in terms of health of dealers?
Just in terms of their willingness to spend on platform or on you know, your kind of platforms, etc., for marketing and for acquiring vehicles in the used side, both those things.
Yeah, we've generally seen we've been through a trend. I'll give you a new car industry trend. So we basically what we've seen till 2-3 years ago maybe 2 years ago, that dealers and manufacturers cutting or reluctant to spend because certain vehicles are not available for supply. There were supply chain issues, etc. There was post coming out of COVID. Then the volumes of sales have gone up, and now demand seems good and supply seems good. So we're in a favorable situation where supply is available and demand is good as well. So dealers tend to spend, and manufacturers tend to spend too to increase sales because there is supply available. I think in the used car industry, it's very early days in monetization by itself. Even though OLX is very strong at it, it's very, very early days. The used car dealers are still not got used to spending large amounts of money on advertising or selling of vehicles. And I think that change is now ready to happen where if dealers have to, divert lots of their money towards digital advertising or spending money on selling the vehicles on platforms like OLX. So that trend is still, I would say, probably going to start in India now.
Got it. Thanks for that.
Yeah,
and my last question on the standalone business side, I know you don't have a guidance as such on the growth side, but I'm just wondering if there's a certain growth rate you need for margins to expand in F25 versus what you had in F24. Is 15-16% growth rate in the standalone business good enough for margins to expand? Given I asked that because
whether you have 10% or you have 15%, you have 20% or 30%, margin expansion will probably happen in all our businesses. I think internally also, and we said in the last call, and you've seen this in the consumer group, of 19 to 26%. We have given tremendous guidance to all our teams to improve margins. I think we are a management or a company which is not only focused on revenue growth and customer growth and customer satisfaction and delight and building great product and tech, but we also believe in working around and making sure our margins continuously improve. And even over the last 3-4 years, the company has continuously demonstrated how their margins have gone up as increase in revenue. So we believe that this year, in addition, we should see, irrespective of revenue growth, we should see margin growth.
Got it. Thanks. That's very helpful.
Thank
Vinay. Thank you. Those are my questions.
Thank you. That would be the last question for today. I would now like to hand the conference over to management for closing comments.
I just want to thank all of you for joining in for this 1-hour session, and we feel, pretty optimistic about the position of the company as demonstrated, as well as the foundation, the base we have from our last financial results in Q4 of last year. Look forward to seeing you again in the next quarter results, but thank you for joining in today. All the best. Thank you.
Thank you. On behalf of Cartrade Tech Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.